here's another great story that I'm privileged to have Jason up here with me, because Jason, well, we're going to talk about your third of your 4 deals, right?
Third deal, yes, sir.
That we're going to talk about. So let's get to, before we do that, tell us a little bit about, when you came on board, what you were doing prior to Lifestyles.
Yeah. So I was a typical. My family. I was the first kid to go to college. So none of my family has gone to college. So they said, Jason, go to college, get a degree. So that's what I did. I went into management information systems. Didn't know what I wanted to do. So I like business. I like computers. So I matched those 2 together. Then I got out of school, and then I went straight into corporate America. So I was an IT global program manager for 15 years. So that's all I knew. And then 2 years into it, you'll see in the next slides kind of what happened from there. I knew that wasn't the path I wanted. So what brought me to Lifestyles, following slides, you'll kind of see I had a lot of single family homes, but I didn't know anything about apartments, zero. So I heard these terms like NOI and cap rate, and I said, what the heck is that? I know single family to 4plexes, but nothing about apartments. So that's the main reason why I joined. And then I went to a couple case studies in the introductory workshops, and then I kind of found my people, because David Fisher was the guy back then. He's completely non-politically correct, and I fell in love right away. I found my people right away. So people are up here in shorts and flip-flops, laid-back people. So I found my crew. So.
But you did, before you got into you did a lot of single-family housing and all that, and this is just an example of some of the things that you were doing as you got started.
Yeah, and I started, so I knew 2 years into corporate America, I didn't want my boss's boss's boss to be the route for me, 20 years later, and I got to work for my pay raises, so my way out was flipping houses back when all those shows were popular. So I did a flip. I had a good real estate agent buddy, and I told him to find me a property. It was in Southern California. Found me one, needed some work. I had all the family come over. We did all the work, did everything wrong. It should have been 2 weeks. It took me 3 months to do. Made a little bit of money. And then I've had another buddy that was in the data analysis world, and I said, hey, where are the best markets to invest with potential? And he said, Texas, Florida, the Carolinas. And I searched and found a 4plex in Austin, and then bought that sight unseen. And you can see that was kind of the progression of everything. So I bought the 4plex, made some money, enough cash flow to buy 2 duplexes the next year, and then actually moved to Austin, Texas from California, and then got sucked back into corporate America for 3-4 years. Went through a bunch of rounds of layoffs, dodged all those, and I knew I didn't want the golden handcuffs. You get the 401k and you get the insurance.
Right.
So they suck you in there, and then I knew the route out was real estate, but I didn't know how. So you can see I just kept buying more 4plexes. And then I joined up with you guys in 2015.
Yeah, so here it is right here. You retired in 2016.
Yep.
And so this is a look at your portfolio after you had joined Lifestyles in.
Yes, sir.
And so you do some passive investing then too.
I do. That first year after joining, I doubled the amount of properties I had within 1 year.
Yeah.
In 1 year, it took me 10 years to build up by myself.
So let's go ahead. Let's talk about Presidio. So this is it, 130 units.
Yes, sir, 130 units, built in 1970. So this was a unique time to buy. This was during COVID. So we got it, they listed it for $12 million, and then we got it under contract right when COVID started for 11.4. And then the banks were saying, whoa, with this COVID, we don't know what's happening. We don't know if we can lend you money. So I went back to the sellers and said, hey, we need a financing contingency, and I need another discount to make it work. And they agreed. Couldn't believe it. So we got a 11%, $1.2 million
Which
COVID
took it
discount.
down to $10.7 million.
Correct, $1.2 million.
Yeah,
yes, sir.
Fantastic. You're a good negotiator. I mean, you use COVID to its best ability,
they needed to sell. They wanted to get the money and get out.
One of the things you see on here is cash out of pocket. You see the $4 million. That's the amount of money that Jason had raised. That's passive investor money that was raised. This isn't 1 or 2 people or just Jason putting $4 million. This is a combination of
40 people.
So this is 40 investors that make up that $4 million on that. And we'll come back to that as we show you the numbers and the performance of the property. So, and see what kind of return from that $4 million. I wish we had 3.24 financing today.
Some people call that a liability, but in this market, it's an asset. They just raised rates, what,
Free money.
75
Yeah,
basis points
75
today or
basis
yesterday?
points, yeah. And so you put $1 million in this property, capital repairs.
Yep.
That you had, and a 10-year on it, 30-year AM.
We're 2 years into it right now. So we got 8 years left on the loan at that rate, which is amazing, fixed.
All right, you want to talk to us a little bit about income and expenses?
Yeah, so this is our year 2 pro forma. We're on year 2 right now. So we owned it year 1. We met those pro forma results into year. So I think you'll probably just want to look at the cash on cash. So projected end of year 2, we're projecting 8.26%. And all those other numbers, if you go through the training, will make sense to you, the NOI and all those numbers. But we have distributed over $500,000 already in under 2 years to all our partners, which is great.
Remember what they paid for this property? What was it? 10.7 million? Current value, we'll show you, we'll break all that down, 14.2 million. Pretty nice, huh? We'll take a look at that. We'll take a look at that in a moment. So let's talk a little bit about, the things that you've done on the property,
You see those
before and
counters?
after. So there's before, that looks like
Those are
one of the
original.
kitchen areas.
Original countertops.
Oh yeah, very
Not a
nice.
scratch on them. The flooring too. So it didn't have to replace the counters on that. We just resurfaced over them. Perfect condition. So we just do standard make ready. All my properties, everything, my personal stuff, all the multifamily. We do boring 2-tone paint. We do a vinyl plank, and we do a backsplash and resurface with black appliances. I mean, easy and simple, and it looks a lot better than the original.
What's
we just
really
cleaned it up.
important is that you understand who your resident is, and you tailor your make-readies and unit turns based on your comps in the area and to maximize your rent.
Yep, we don't over rehab.
Here's another one. What do we have here?
So we just
This looks
freshened
like
it up.
grandma's kitchen or living room. Okay.
Yeah. Yeah. That's dated. Those curtains smell like smoke in there. Oh, it's horrible. That shag carpet.
That's one of your models?
This is the model unit, yep. So that's
Okay.
the standard, what we like every unit to look like once we're done with it.
And
Was it a model before?
No, so
No?
we
Okay.
we rehabbed it. It's their standard. I mean, everybody knows our paint and flooring and just standard fixtures. Quick
yeah,
and
it's
simple.
really important. If you don't have a unit to show, you have a model that's representative of what that unit would look like.
Yep, yep.
All right, the next one here. Okay, these
Same
are,
with the bathroom. We just clean it up. We resurface everything, and we just make it look brighter and nicer. Nothing. We don't go overboard with our rehabs. So we have a budget, and we need to stick to it. So it's just a standard resurface, bathtub, and I think we'll want to put a nicer mirror. It's an old medicine cabinet, but I didn't want to, pull it out. But
who wants to swim in that pool?
yeah, before and after.
So did you go in, resurface the pool?
We didn't have to do that, so there were
Okay,
tadpoles in it, so we had to get rid of all the tadpoles. I
Yeah.
think it might have been a frog in there, and then we just sprayed it down and then cleaned it up. So night and day right there.
Good.
Any idea why it was in that condition?
Pump failed. If you let it go a few weeks and the pump goes out, it turns real quick and it's hard to get back. So you gotta have your maintenance guys stay on the pool and upkeep.
And they were probably undercapitalized and just didn't want to
Yep.
fix it, so forth. Okay. Let's talk a little bit about the numbers. So we're in year 2. We talked about, where the operating expenses are, where the income is. And there you see that 8.26% that Jason was talking about. And then as you can see, as you get to year 3, how that income continues to grow. And the one thing I want to point out is notice how his expenses are going up too. We want to make sure that we continue to invest back into the property and we're doing the right things. But the rate of return on that for year 3 is about 9%. So here's one I want to talk to you about. Let's say that after year 3, Jason and his investors decide, you know what? I think we're going to sell this property. He communicates with them. He talks with them. They're all in agreement. All right, what happens? Well, based on the NOI of 749,000, just pay attention on just year 3 for a moment. So we know the property based on that operating income of $750,000, the property is worth nearly $15 million. Well, what's the first thing that has to happen? He's got to pay off his lender, right? He's got to pay the debt off. Well, he's got $8.1 million. He's got to pay that back. What happens from there? The investors have to get all of their money back. Their capital has to be paid back to them. He raised $4 million. All that money comes back to him. At the end of the day, once you add back in all the cash-on-cash distributions of 3 years, a little over $1 million, there's a $3.8 million equity capture off of that $4 million. That's essentially close to doubling your money within three-year period of time.
Almost, not
Now,
too shabby.
this is making an assumption that if they were to sell in year 3, that may happen, it may not. It depends. Nice job, Jason.
Thank
Very
you.
good.
Appreciate it.
Appreciate that. Very good. So in this case, it's like a 34% return on your money over that 3-year period of time. So.
And a 5 cap's pretty conservative. We're selling a property right now, and it's a Class C, and we're getting about a 4 cap for it. Cap rates have increased a little bit, which I'll teach you about if you haven't gone through it, which means, the prices go down, but I think that's pretty conservative.
Yeah, for the new folks in the room, he's really nerding out with cap rates. We will discuss that in a 2-day seminar. Come hang out with me.
Chris will talk all
go over
about that. You'll learn more about that in his 2-day over the weekend. Tell us a little bit about the things that you did. When we talk about net operating income, unlike single family, net operating income is the key driver of the overall value of your property. So in multifamily, you're running a business. You're running a business, the value of that business. We're not, unlike single family, which is brick and mortar and whatever the market will bear. In multifamily, it's all about net operating income, and when you can grow that, you can take your property from a $10.7 million purchase price to $14.9 million on where the value's at. So what are some of the things that you did to grow that operating income?
Yeah, and full disclosure, Doug's my mentor and Teresa's my operations consultant, so they help me come up with this plan. So we do feasibility, and we see where the deficiencies are where we can increase, and just rehabbing the units. I mean, taking from the old dingy to the new, we get, extra rents, and then we reduce, they had high vacancy, so we reduce that. That brings up income. And the one I like the most, I do it on every property. Most don't do it, but we do reserve parking. So we reserve cover, we charge for it. We do reserve parking the closest to their unit, and people pay for it. That's a huge NOI increase. And then, go ahead.
No, go ahead.
Oh, and then laundry. These laundry contracts are absolutely horrible. I don't have any contracts on my properties, but they lock you in for like 14 and a half years. And luckily, this one was going to expire. We gave them complete notice. So what we do is we get all these contracts out. We were getting about $300 a month, and now we put on our own. They're really cool Bluetooth machines, brand new. They go in just all on their phone, and we increase, income. What is it, 24,000 a year, just doing that. And we paid, I think it was about 15,000 for the machine, so they're paid off already. And then we do a lot of little stuff like cable revenue. We contact Spectrum, and they give us a kickback for, if they sign up for cable TV. So just a lot of little things, and that adds up to something big at the end in the value.
Just that a little amount from getting your NOI from like $712,000 to $749,000, just that $30,000 or $40,000 increase is a substantial increase in the overall value of the property.
Yep, absolutely.
So these are the things that we're always looking for, is new ways, innovative ways to continue to grow our NOI, and we talk about it every day and try to do those things. So you enjoying what you're doing?
It's a job. I'm enjoying it, but I want to be like Dustin and Sandy when I grow up, and Madeline. That's the goal. I want to be here doing nothing, collecting all the checks, but it is a job. I love it. I think I have good experience doing it.
Well, you get to be your own boss.
That's it.
And, you know,
No more golden
you get up and go
handcuffs.
to work when you want.
Yeah.
You got a lot of responsibility.
Yes, it's-
A lot of fiduciary responsibility
Absolutely.
because you have hundreds of passive investors that you report to. But you control your own destiny, and that's really what it's all about.
I do, and I don't have to go to my boss to ask for a raise or stay there for a measly 3 to 5% a year, increase. I go after my pay raises, buy more properties. So you control your destiny, and that's
what's really good.
Yeah.
So what's next? What's in store for you next?
So I think I'm going to continue doing what I'm doing, passive, have my own properties, and then be a lead. I think I'm going to lessen my lead presence and again, be more like Dustin and Sandy. I mean, I want to go more into the passive, but I still will lead my
So
deals.
you want to become lazy?
I want to become lazy, yes.
Lazy money's the way to go.
Have all my pictures of my checks up there. That was pretty cool.
Do you still send checks?
No, ACH now.
Well,
Yeah.
you
Some
got to
people hate
change that.
I know. They love going, getting, cashing it. And you can scan it, though, with your Chase app now.
That's right.
So you don't got to go to the bank. But yeah, I just want to go newer. I mean, I cut my teeth on the old stuff, lots of tenants, lots of problems, older property. So I think I want to go bigger now and then a little bit newer, have a better quality of tenant base as things get tougher and the market changes.
Jason, I want to tell you that I enjoyed your story on Presidio Flats. It just seems like it was a few weeks ago we were doing
Yesterday.
feasibility on it.
Yeah, 2 years.
We had to wear our masks and rubber gloves to walk all the units. Remember all that? We had to go through COVID doing all that, but
Yeah.
we got it done, didn't we?
We did it. We
And
did.
we looked at this property and man, I remember talking to you about that whole negotiation process
Right.
and taking them from the 12 million to 11 something and finally signing at 10.7.
Yes, sir.
That was a wonderful job. That really was. And then we learned a lot during feasibility. I knew you had a good game planned, and it's turning out the way we planned it, the way it was supposed to be.
Yeah.
And so anyhow, thank you for giving back time, sharing it with our folks today. And as I started, I talked about this is what case study is all about. It's for you to learn about our members and what they do. And seeing it for yourself. And I get the privilege every month that goes up here, case study is to tell a different story from a different member with similar results. And so it's just fantastic. So thank you, Jason. Let's take some questions if we can, see what we got from here. Yes, sir.
Did you have to add any covered parking, or you started giving reserved parking, charging for reserved parking?
Did you, the question is, did you have to add additional parking or was it already there and you just started charging for it?
This wasn't a setup, Carson. You're in my properties, right? No, this one had it already. So a lot of these probably have them and they don't charge because they don't want to scare tenants off. I don't know why, or residents, we call them. But this one had them. What a lot of people aren't doing is charging for uncovered. So that's where we're coming in the closest spots to units. They want their own spot right by their door, covered or uncovered. So that's where we come in, an extra layer of parking income with the uncovered. But I haven't put in any covered at this point. I didn't plan that in my CapEx budget.
I have questions for you.
Yes, sir.
You mentioned 40 investors.
40 investors.
Are they all here in San Antonio?
All over the U.S.
All over the U.S.?
Yeah.
And they all put in $100,000?
No, anywhere from 25 up to 200.
So for $25,000, you could own a property like this?
Yeah, we always hold a couple low spots for first-time investors, so that's just the Lifestyles model. We always help out somebody that, just starting out for the first time.
The scared
all have a
folks
minimum.
like Sandy and Dustin?
Yeah, they don't need that.
Or the people that run out of money.
Yeah.
You heard them talk. You're going to run out of money before you run out of deals. So if you can find 10 grand and put it in a deal like this, make 100% return on your money in 3 years, would you?
Go.
Why not?
Foundation issues in multifamily to like single family?
So tell us a little bit, have you had foundation problems?
Yes, absolutely. All types of properties have foundation issues. You go in with feasibility, we inspect everything. So we got our foundation expert. This property didn't have any, so we inspect.
Here's what I would tell you. Most every C-class, B-class property has some sort of a foundation issue. It's just there. It's not something that we really take into something serious that we need to look into unless there's significant cracks that are in the walls, the doors aren't hanging up right. But there's always going to be a variation in the elevator. It's just common in multifamily. So it's not alarming to us unless it's a significant, huge issue.
Yeah, you don't want to set a bowling ball on one side of the room and have it roll 10 miles an hour to the other side.
Yeah.
Slow roll's okay sometimes.
What paint color and cabinet color you use?
So the question is how do you go about paint colors?
Yeah.
Selecting paint colors?
If you want to email me, I can send you the specific color. It's Sherwin-Williams. I know it's web gray, the dark cabinets. I forgot the other color, the light gray, and then just the pure white for all the trim and ceilings. But if you want to email me, I can get you the details. Real boring, but simple.
All right.
We got one.
Where in San Antonio is it?
North Central. So I like to keep all my properties close for economies of scale and to share staff when I have problems. But I'm in the North Central. I live in Austin, but I have one, pocket in San Antonio where I like to keep all my properties.
Is there anything up there you want?
Yes, it's growing like crazy. It's just a good working class area. Just good Class C properties if you buy right.
All right. Josh DeLeon wants to know your opinion on, knowing what you know now, what is the fastest way to grow wealth?
Hey, what's up, buddy? That's one of my buddy Josh. The quickest way to build wealth. I took the slow route, so you can see the first 10 years were single family and slow. If you have a lot of capital, I think the quickest way is becoming a lead. You can make a lot more money, but it's a lot more work. But if you have a W-2 job, it's all about picking the good leads. But I would say IRO, so it depends on what your goal is. I wouldn't say there's one specific quick way. It depends on how much money you have and what your goal is, whether you're working or if you want to do it full time. But for me,
I
it's
think
being a lead.
the other one is passive investing, similar to what Dustin and Madeline were talking about, and that is, take that capital, immediately reinvest it, and live off of the cash flow. That's one of the quickest ways. Don't
Right.
sit on your cash, get it reinvested.
You're losing, 15% inflation right now? Or they say 8, but you're losing a lot of money if it's sitting in the bank. So get it into hard assets. Yep.
Question, I guess, for you, Jason, or answer here. In the economic environment that we're in right now, if you had a couple $100,000 to invest, put some of it into single family, maybe some duplexes or fourplexes, and multifamily both, or stay in multifamily?
Well, everybody's situation is different, so I can't speak to that. I can tell you what I would do with a $100,000 investment. I would be looking for something that has some sort of a short-term refinance where I could take that money out, reinvest it in another property, and still own the existing one, although refinancing can be a little bit more difficult right now with interest rates rising. So as Madeline talked about, you're not seeing as many refinancing. But I would look for that opportunity that had a refinance where I might be able to get 60, 70, 80% of my original investment out quickly, where I could take that and reinvest it and still own the asset, have 100% of my equity or my original investment still in that first deal. That's what I would look at.
Duplex, fourplex, or what would you do?
You mean the type of asset? Again, you really got to look at the performance. You got to look at the overall investment. What's the plan with it? I mean, I've invested in all different type of assets where, they're longer term holds. I've had some that are value plays that I'm not going to see a payout for 2.5 years. There's not anything specific. I got to look at each individual deal. I'll have people that'll ask me about a certain investment, and they'll say, "Doug, are you investing in this investment?" And I'll say, "Yes, I am." they'll say, that's good for me. No, it's not. I don't know what your investment criteria is. Yours might be completely different than mine. I might be willing to take more risk than you are, or you might be willing to take more risk than I am. So you got to look at each deal independently and come to the conclusion if it's the right investment for you. And that's where your mentor can help you. If you're looking at some things and trying to decide which way you want to go, well, that's where you can talk with your mentor or a passive mentor to give you some guidance and direction. We're not going to make that decision for you, but we can certainly have that discussion with you.
Yeah, I just wanted to lean off of y'all's wisdom, y'all's experience.
Yeah. Yes, sir.
So, question for Jason. Given what you know now, right, and given your situation at the time when you first started with the single families, would you do it the same way again, or what would you change?
Oh, I hate
Okay,
having
so
regrets.
the question was, you went through your learning curve in single family.
Right.
You're now into multifamily. Over that period of time, would you have done anything differently?
Yes. What would you do differently? I hate having regrets, you know, but I wouldn't change anything. But looking back, when I first started, apartments were, you know, 20, 30,000 a door, and it was an 8, 9 cap rate, and now they're 4 to 5 cap rates. I would have went into multifamily way sooner. So that's what I would have changed, and there would have been a lot more units on there, and I'd probably be completely retired now.
I'm going to pigtail off of that, and I go over this in the seminar. Single family is not a stepping stone for multifamily. If you can go straight to multifamily, do it. I couldn't. I had to start in single family. I didn't have the money to go to multifamily. But in your case, you could have, you just didn't know how.
Exactly.
So that's why we're here.
Good question.
One more? No? Online? Where do you get a shirt? My wife made the shirt. It's unlicensed, so I cannot sell them. All right.
Okay, was that it on questions?
Yep.
All
I don't
right,
see
very
anything else up
good.
there.
Jason, thank you very much.
I
Appreciate
appreciate
you
it.
giving back and telling